afternoon. First of all, I would like to thank India Gold Policy Center, India Institute of Management, Ahmedabad, for providing us this opportunity to present our paper and share our thoughts. And I'm going to present this paper, Hedging Properties of the Gold in an Emerging Market Economy, an application of ICPM model or intertemporal capital asset pricing model. And this is a joint paper written with one of my PhD students, Bhishma, my collaborator, Professor Paramita Mukherjee, one of the co-recipients of the M6 award. And basically, let me give you a brief background of this paper. As you know, there has been an enormous growth in the global financial markets, including the emerging market economies, in terms of the trading of variety of financial instruments as well as the volume of the trade. However, various adverse economic events, including the global financial crisis, US-China trade war 2018, the global pandemic, and so on and so forth, and also the higher interconnectedness between or among these different segments of the financial markets, exposed all these markets to the risk of the higher volatility through the asset price bubbles. And Indian financial market, of course, is no exception to that. Indian market also witnessed substantial growth domestically as well as internationally, and definitely achieved the greater international integration, reinforced by the process of the globalization and the liberalization. And at the same time, I must say that it also led the Indian financial market to be more susceptible to the external shocks. Increasing interconnectedness of the Indian markets and the rising uncertainties arising out of the the different types of uncertainties like economic uncertainties, geopolitical risk, etc., necessitated kind of the diversification of the portfolio by the investors. Investors essentially are primarily motivated to allocate funds to the safe assets as a means of mitigating the risk exposure. And ultimately, it underscores or emphasizes the need for a hedge or safe haven to safeguard investors from the adverse economic events and the potential losses. Now, in this context comes the most important role that the gold is supposed to play. In fact, gold has several advantages. Over many other risky assets, gold receives significant attention due to its remarkable performance during the global financial crisis. As we have observed that the gold prices have significantly increased, some other speakers were mentioning in other talks. Gold acts as a hedge amidst economic uncertainties. It is considered as a safe haven since it acts as a stabilizing force under extreme economic turmoils. Gold prices remain relatively high, while those of the other risky assets experienced a decline. As you know that the gold price experienced a consistent rise in until 2016, with occasional declines in 2013 and 2015. Global stock market volatility, surge in inflation, geopolitical and economic uncertainties, as I have already mentioned, contribute to the increased demand for gold for investment purposes. Gold acts as a risk diversifier, inflation hedge. It carries a low transaction cost, and gold also provides the equity-like returns, and that have been reaffirmed by many researchers from time to time in the existing literature that you observe. Now, I have put few papers, few findings from the few papers here. We have an extensive survey of the literature that we have done, but some of the findings like Boyer and Lucy probably might know that 2010 they observed that the gold acts as a hedge and safe haven in few markets like USA and UK, but not for other markets including the BRICS. And even interestingly, in the most recent works, if you look at the last two papers, you may see that the gold acts as people have seen that the gold acts as a hedge against the risk caused by the COVID-19 period for the stocks in certain sectors like tourism. Empirical findings also suggest that gold acts as a safe haven asset during the time of the COVID-19. So from these findings, the previous research findings as well as the most recent findings tell us, indicate that the gold definitely act as a safe haven as well as the hedge. Now, given this background, we attempt to assess the hedging effectiveness of the gold against the stock prices in the Indian stock market in a multi-period setting of intertemporal risk-return relationship. Now, we essentially we examine the cross-sectional intertemporal risk-return relationship using gold prices and the treasury bill rates as the hedging variables. In fact, we have considered the two hedge instruments, alternative hedge instruments, the gold prices and the treasury bill rates, which is considered the safe asset generally in the financial markets, and try to assess whether it generates adequate risk premium, in the market, given that these attributes of the gold are not homogeneous across all the stock markets. Now, for this purpose, we have used a framework called the intertemporal capital asset pricing model, which is a much more general type of model, unlike the simple capital asset pricing model. Simple capital asset pricing model is definitely widely used models for describing the prices of the financial assets in a risk return setting. However, this CAPM, the earlier model, faces several empirical as well as theoretical challenges, given that it is based on the mean variance criteria of the investor's choice of the portfolio. It is based on the assumption of the homogeneous expectations, and it is a single period model. It is important to understand how the risk return relationship changes over time, and this ICPM model, which was developed by Met in 1973, that helps us to capture this, given that it also posits a positive relationship between the expected return and the risk. Unlike the basic the CAPM, traditional CAPM, it is a multi-period asset pricing model. It's a continuous time framework model. Definitely it maximizes equilibrium model that maximizes the expected utility over the lifetime consumption, and investors are compensated by additional risk premium. This is the most important feature of this model for bearing the risk associated with the variations in the investment opportunity set. Now, this investment opportunity set actually includes the safe assets like the gold or the treasury bills. Of course, there are many authors have taken many other macroeconomic variables in the investment opportunity set, like Boyer and Luce have used the exchange rate and many other variables. And in this model, unlike the traditional standard CAPM model, the hedging occupies a predominant position. And that's why we have this model has certain advantages over the basic model. Now, I'm not going into the details of this model, the technical details, but just let me tell you that the Metten ICPM entails the following equilibrium relationship, where mu is expressed as a function of the covariance of the return of the market portfolio and the stocks, and the covariance of the hedging portfolio and the risky assets. And here in this equation, A denotes the average relative risk aversion slope coefficient. Covariance of M, COVM, this is denotes the covariance between the returns on the vector of the n risky assets and the market return. And B is a vector that reflects the reaction of the market to the shifts in the investment opportunity set. And the covariance of X, the COBX, denoted by COBX in the right hand side of this equation, the second component, denotes the covariance between the risky assets like stocks and the state variables. In our case, the state variables is the this gold, and alternatively we have used the treasury bills, right, which is considered also to be a safe asset. For a single risky asset, the ICPM relationship can be depicted as follows. The mu I minus RF equal to A into small sigma IM plus capital B into sigma IX, and left hand side actually gives us a measure of the expected excess return, and the other notations have the same interpretation as I've already mentioned. Now, the most important feature of this ICPM model is that empirically this model is said to be valid if two conditions are satisfied. The first is the positive common slope coefficients, that is A must be positive. A must be positive, and the second is the zero intercepts, that is Ci must be equal to 0. Although researchers, I mean, in different financial markets have observed different types of observations, not necessarily always both the conditions are satisfied, but we also have this similar type of observations. And for this estimation of this ICPM, I mean intertemporal capital asset pricing model, first we employ a time series model, there is a Garch model, to parameterize the conditional covariances, because one of the most important challenges of this model is that to estimate the covariances. We have the two covariants in this model, covariance of the market and the risky assets, and the covariance of the stocks and the risky assets and the state variables. So for that, we use the one particular variant of the Garch, that is the M-Garch model, multivariate Garch model, that is generally written as in this way, in this fashion, that RT equal to mu t plus epsilon t, where mu t given the information set in period t minus 1 follows the normal distribution 0 ht, where RT is the vector of the returns, mu t is the k by 1 vector of the parameters, and mu t is the error vector, and ht is the conditional covariance matrix which we want to estimate, which is a function of the information set in the previous period. And for the estimation of these covariances, we apply the diagonal Beck-Garch model to calculate the required covariances. So this is the most important, I mean the challenging part of the estimation of the model. And in the first in the second set, this estimation has two parts. In the first stage, we estimate the covariances, two covariances. In the second stage, we estimate a pricing equation, which is estimated by employing a method called SAR model, the seemingly unrelated regression analysis, which is it estimates jointly all the equations taken together with the state variables, gold price, and the TBR. I mean, if we consider the BSE Sensex, we would have the 30 equations, or if you consider BSE 500, we have 500 equations we have defined in our model, and the SAR regression model simultaneously estimates all these equations, and it involves a joint, that's why it is mentioned that it involves a joint estimation of all equations together with the state variables, gold price, and the treasury bill rate. Now, this is the pricing equation that we have finally estimated. This is the second part of the estimation. RT plus 1 equal to CI plus A, sigma IM T plus 1, B1, sigma I gold T plus 1, because we have the two hedging variables like the gold and the treasury bill rate, plus B2, sigma I TBR, TBR stands for the treasury bill rate T plus 1, plus epsilon I T plus 1, which is the error term. And A, B1, B2 are the common slope coefficients, Ci is the intercept, and the sigma I GLD, sigma I TBR are the conditional covariances between the stocks and the gold price, and also the conditional covariance between the stocks and the TBR, the other safe asset. Now, the return series are calculated by the simple log difference. The R stock is the log stock T by stock T minus 1. Now, in the first set of analysis, we consider the BSE 500 index and construct the 4 different portfolios of our own. We have constructed the portfolios based on the value of the market capitalization of the constituent stocks as on January 2022. Stocks are arranged in ascending order of the value of the market cap and are categorized in the 4 quartiles. And therefore, we consider the 4 stock portfolios: small cap, mid cap 1, mid cap 2, and large cap, because we handle the 500 stocks and BSE 500. Similarly, this analysis is carried out for the other 2 indices, alternatively S&P BSE Sensex and Nifty 50. And we carry out this empirical exercise and whole exercise based on the for the period December 16, 2005 to June 30, 2022, and we have used the daily stock price data covering 3863 daily observations. And this is the description of the variables. So we have used huge the data. Obtained from the different sources, BSE 500 portfolio excess returns, S&P BSE Sensex, Nifty 50 stock excess returns, conditional covariance of the BSE 500 stock portfolios. We have estimated all these for the gold and most all these stock price data we have obtained from the Prowess database provided by the Center for Monitoring Indian Economy, and the gold prices and have been collected from the MCX because MCX is the only reliable source which provides this consistent data of the commodities like gold. And for the treasury, other safe asset, we have considered the 91-day treasury bill rate, and we have collected this data from the EPW Research Foundation. And then we have estimated alternatively different models for all these alternative the variables in the first column that you have defined, because in the first column we have listed various alternative stock portfolios, BSE 500, S&P BSE Sensex, Nifty 50, BSE 500 stock portfolios, Nifty 500, etc. And this is, I will present, I'll show you a few tables, not all the tables and all the details. This is the table which shows the risk-return relationship as per the ICPM, because ultimately we have estimated the intertemporal capital asset pricing model by all these processes. This is the table which shows the risk-return relationship for BSE 500 stock portfolios without intertemporal hedging demand. Without intertemporal hedging demand means we didn't consider the the hedge assets like the gold and the treasury bill rate. And what we have observed that the coefficient of the covariance of the market that is positive and significant. This is the risk aversion coefficient. This is the risk aversion coefficient A in our empirical model that I have specified in the previous slides for the BSE 500 stock portfolios, and this is estimated to be 2.10 and significant, indicating a positive and highly significant association between the risk and the return. Because one of the fundamental prediction of the intertemporal capital asset pricing model is that risk-return relationship has to be positive, must be positive. In the next table, in this table 2, we have included the safe assets that I have defined. We have defined the investment opportunity set, which includes the treasury bill rate and the gold, which are considered to be the safe assets. Here also we find that the coefficient of the covariance of the market that is again significant and positive. So the risk aversion coefficient is intact, positive and significant, one of the important requirements of this model to be satisfied. And similar is the case with the covariance of the gold and covariance of the treasury bill rate. COB GLD and COB TBR actually denote the covariance of the return between the gold and the risky asset and gold stock, and the covariance of TBR denotes the covariance of the return between the treasury bill rate and the stocks. So both these coefficients are positive once again in this equation, in this table, 19.147 and 5.489. And in the third table, quickly let me just show you that this is the risk-return relationship for S&P BSE Sensex. In table 2, we have estimated the risk-return relationship for BSE 500 stock portfolios. We have defined the 4 stock portfolios based on the BSE 500. Small cap, mid cap 1, mid cap 2, and the large cap. And we have simultaneously estimated this model. Now in table 3, we have considered alternatively the S&P BSE Sensex because it consists of 30 selected scripts with intertemporal hedging demand and the market return of the BSE 200. In this case, in this table, our proxy of the market return is BSE 200. In the previous case, we considered the BSE 500. Here it is 200. Here once again, we find that the coefficient of the covariance of the market return is positive, that is the risk return positivity coefficient of this, the relative risk aversion coefficient is positive. And also we observe that positive coefficient of the gold, which predicts positive future market returns. Gold is considered to be a price risk factor with a positive risk premium and negative intertemporal hedging demand, because the coefficient of the COB GLD in the third row, you can see this is positive and significant. That essentially indicates that gold is a price risk factor and with a positive risk premium and a negative intertemporal hedging demand. And also it indicates favorable shifts in the investment opportunity set. So now in the next table, this is the last table that I am showing up. There are a few more tables which I am not going to present here. In this table, we have presented the risk return relationship for Nifty 50. Alternatively, we have considered the Nifty 50 stocks with intertemporal hedging demand and the market return of Nifty 500. Here, our proxy of the market return is Nifty 500. And we have considered the 50 individual stocks included in the Nifty 50. And then we have re-estimated the model. And interestingly, we observed that our first condition of this ICPM to be valid, that remains intact. That is the coefficient of the covariance of the market return. That is 3.377. This is the coefficient. And also for the covariance of gold, it is also significant and positive. But for TBR, it is negative, it is observed. So conditional covariance of the individual asset return with the gold return shows that statistically significant and positively related, signifying that gold prices can predict the next period's return on the Nifty 50 stocks. Essentially the observation is that statistically significant and positively correlated, which signifies that the gold prices or the gold return predict the next period's return on the Nifty 50 stocks. And also it indicates the favorable shifts in the investment opportunity set and negative intertemporal hedging demand and definitely positive risk premium. So based on this, the findings that I have, selected findings that I have presented, these are the observations which I have already mentioned, but let me just repeat that based on our SUR estimation, seemingly unrelated regression, it is an estimation technique which estimates all the 500 equations or all the 50 equations for the Nifty 50 taken together and simultaneously estimates. Based on these estimations, gold as a hedging variable appears to be a priced risk factor and can be considered as a proxy for the investment opportunities. Our results at least show that. In table 1, which I have already presented, the risk aversion coefficient A for the BSE 500 stock portfolios is positive and highly significant. That implies a positive relationship between the risk and return. The relationship between the risk and return has to be positive as per the prediction of the ICPM without the intertemporal hedging demand. And intercepts are not jointly equal to 0. Another condition of the ICPM to be satisfied is not satisfied in our case, and we were a little bit scared that whether both these conditions have to be satisfied uniformly. But Boyer and the Luce and many others have seen that that condition may not necessarily be satisfied. In our case, in Indian financial market also, we have seen the similar type of findings. In table 2, the hedging demand is taken into account. We have considered the gold and the treasury bills. And the risk aversion coefficient is still positive and highly significant. And the estimated coefficient of the gold is positive and significant, imply gold is a price risk factor with a positive risk premium. Estimated coefficient of the treasury bill rate is positive and also highly significant, that which implies that TBR is also, the treasury bill rate, which is also considered to be a safe asset, a price risk factor. And similar analysis also we carry out for S&P BSE Sensex, table 3 and table 4 that we have presented, depict positive estimates of the gold, but we find the different, some different types of results for the TBR. So what we conclude is that first, the relative risk aversion coefficient remains positive and statistically significant both with and without incorporating the intertemporal hedging demand. Intertemporal hedging demand, by this term, I mean by including the safe assets in the hedging portfolio, gold and the treasury bill rate. Secondly, the positive risk aversion estimates are robust to alternative stock and the market portfolio specifications. We have alternatively used several market indices, BSE 500, BSE Sensex, Nifty 50, Nifty 500, BSE Sensex 200, and alternatively we have estimated, and our results are more or less robust. Third, gold returns act as a hedging variable, appear to be a price risk factor. It depicts favorable shifts in the investment opportunity set. In the literature, it is considered, it is argued that it means that it depicts a favorable shift in the investment opportunity opportunity, and it provides a positive risk premium. And the treasury bill rate, of course, display varying results. So what we I mean, certain probable policy implications that we draw from these findings is that investors can contemplate incorporating gold into their portfolios, because investors are mainly concerned about the diversification of the portfolio. For diversification purposes, they can do that, and it is observed that investors are doing that, and construct portfolios to safeguard their investment. And from the policymakers' perspective, the government also can promote to support this the financialization of the gold and establish it as an asset class, which we have already discussed a lot. And this can be achieved by definitely by improving the current initiatives taken by the policymakers, I mean the central bank, as the gold monetization scheme, sovereign gold bond scheme, gold savings account, and so on and so forth. And we believe that this should therefore attract the investors to diversify their portfolios by linking the financial instruments to gold. That's all. Thank you.